One example, the ARC Innovation ETF is down 53% so far this year, although today a move up by 1.7%. By the way, tomorrow Bloomberg's Ed Ludlow will be speaking with Kathy Wood live, 1 p.m. Wall Street time here on Bloomberg Radio. Dow Industrial Average is ahead a 0.5%. We've got the S&P 500 up by about 0.6%. NASDAQ Composite climbing about 0.7%. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. So we do want to get to this story. If we kind of hinted at it, if you're feeling pinched on a $250,000 salary, just wait. This story, by the way, one of the most read on the Bloomberg, and it's by one of our Bloomberg opinion columnists.
It's all based on this survey that Bloomberg commissioned just last week. It got a lot of attention, but we got a great follow-up column by Alexis Leondis, personal wealth columnist for Bloomberg Opinion, who writes that if you're feeling pinched on a $250,000 salary, well, just you go ahead and wait. Alexis joins us right now in the Bloomberg Interactive Brokers studios. So, Alexis, a lot of this has to do with student loans and paying back student loans because, as a reminder for those who don't remember, they haven't been paying their student loans back for the last couple of years.
Right. They've been on hold since March of 2020. That was part of COVID relief legislation. And that's why I wanted to point that out, that if you feel pinched, and there was the survey that was commissioned and respondents said fully 36%, so more than 1/3 said, despite making at least $250,000, and that's individually, at least making that level.
So it's not families.
No, it's not
I was wrong about that. Thank you for that.
So even if you're making that salary or that level of income, you still feel like you're living paycheck to paycheck. So I thought it was worth pointing out that you're feeling maxed out, but you haven't even had to worry about student loan payments. And as we know, student loans are a big deal for this crowd. You know, for higher income, they tend to have professional and doctorate degrees. And because of the high level of student debt, it's been considerable savings that, you know, these payments that have been on hold for, it'll be 30 plus months if in fact the payments resume at the end of August.
Welcome everyone to another edition of Life is a Bummer. I mean, it really just feels like we pile it on, but it is the case. And what's interesting is, and you note this in your story, that Census Balance Survey, they didn't just ask people in high-cost areas such as New York and San Francisco, because sometimes this happens, and we talk about this when we talk about house prices or things. We're like, okay, we know all of you in the middle part of the country are thinking, what is wrong with those people?
Okay, I will say that, and I saw that in your piece, but at the same time, my feeling is, well, are there a lot of people outside of the expensive areas that are making $250,000 a year? So is it? Can we look at this as kind of self-selecting?
I don't know.
You know what I mean?
Yeah, totally. I don't know if it's self-selecting, but what I do think is really important to point out is that these people are self-identifying as saying that they're basically feeling like they're going paycheck to paycheck.
Yeah.
So the self-identification aspect of it, I think, is a little squishy. But as Carol said, it's a census-based survey. It's not just asking people in high-cost areas like New York and San Francisco or Los Angeles, do you feel, pinched or stretched? And also, worth pointing out that when they say they're living paycheck to paycheck, it includes automated savings for things like retirement plans, like 401ks or 529s. So it might not be what I would traditionally think of as living paycheck to paycheck, which is basically you get your check, you pay for food and housing, and that's it. These people are saving for retirement, for their kids' college education. So it can be a little misleading. And I think it's worth pointing out that, again, they're self-identifying as feeling financially strapped.
What I think is interesting, Alexis, and I think it was it Joe Weisenthal's note, 5 Things to Watch Today, and I think he pointed to a Bank of America survey, once again, saying, Americans are still out spending, and they're watching the credit card numbers, but you do wonder that once you have to start paying back, right, the college debt, that, okay, where do you cut back? And I do wonder about the impact ultimately on the U.S. economy.
No, totally. And if you look at the average, so if you went to graduate school, the average amount of total debt you have, including undergraduate and your graduate degree, it's more than $82,000. So that's a monthly payment of $950. So $1,000 a month that you haven't had to worry about. So when that gets turned back on, and yes, we've heard that the president may forgive some student debt, but it would be $10,000. And the reports that we're hearing is that it would only be for those making $150,000 or less. So I think it's safe to say that if you're in this upper income, if you're one of these top 5% of earners in America, you're probably not really going to be getting any debt relief. So you really have to figure out what you need to do budget-wise to start to accommodate
you're
for
choices,
these payments.
Right?
Totally.
You're going to probably continue putting money into your 401k if you have that option, right?
529, you got to pay for childcare.
Right.
But do you have to go out to dinner once a week?
Right. And I think it raises this point of, if you are feeling maxed, is it because of essential non-negotiables, or is it because of discretionary spending going out, like you're saying?
What about housing? And to the extent that in recent months, a lot of people's mortgage payments have gone up because they bought a new home and that home was expensive?
Great question, and I would love to drill down and find out for these people who are feeling that they're over leveraged, how much of it is because of housing. The mortgage rates have obviously gone up, home prices have obviously appreciated. So you take those two together, and I know in the survey it was something like 16% of the respondents who are feeling that they're living paycheck to paycheck are saying that they're paying back. They've made a payment in the last 90 days on a new home loan, or even a second mortgage on their primary home. So I think housing is a huge part of this equation.
You know, Alexis, what I love about this, and we've had some conversations with individuals, again, it also, the rethink on the value of a college education, what it costs, and students who come out and have so much debt. I mean, I really do feel like there's this major rethink going on, and whether or not this plays into it, as people move forward.
Is it worth it? But again, you have to think that people at this income level, they probably feel, societal pressure for their kids to go to college and to continue on, continue to keep up with the Joneses, if you will.
The other thing I like about this story, and Tim and I talk about this all the time with our TV colleagues when we do our simulcast, but it's like, I still feel like we don't know what our economy is because there's just still leftover hangover from all the stimulus or the ability to put off, your payments on your college loans. And so I don't feel like we start to get a real picture of the economy in terms of what consumers can do or not, right, going forward, not until later on this year, maybe even to next year.
Totally. And we're starting to see credit card, the debt, overall level of debt, people taking out credit cards. It is going up, climbing up. But according to this survey, 60% of those who say they're living paycheck to paycheck and make at least $250,000 do not carry balance. So they pay their statements off in full. But I pose the question.
How much longer?
Right. When student loan payments become due again, do you turn to your credit card?
All right, Alexis, we're going to leave it there. Thank you so much. This is among our most read stories. Alexis Leondas, she is Bloomberg Opinion columnist. Check out this story at the Bloomberg.
Let's get to world and national news with Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. Actor Matthew McConaughey is in Washington to push for new gun control measures in light of the mass shooting in his hometown of Uvalde, Texas.
This moment is different. We are in a window of opportunity right now that we have not been in before. A window where it seems like real change can happen.
McConaughey spoke at the White House press briefing. On Capitol Hill, lawmakers have been hearing from witnesses who've been sharing their experiences about people who've been radicalized. Garnell Whitfield is the son of one of the victims of the deadly supermarket shooting in Buffalo.
I ask every one of you to imagine the faces of your mothers as you look at mine, and ask yourself, is there nothing that we can do?
Garnell Whitfield called on lawmakers to address what he calls the cancer of white supremacy. Treasury Secretary Janet Yellen is assuring the Senate Finance Committee bringing inflation down is a top priority, while senators cast blame and offer remedies along party lines.
Ranking Republican Mike Crapo said administration policies discourage additional domestic oil production. Yellen disagreed.
Oil production in the United States fell during the pandemic. I think that oil producers didn't anticipate the strength of the recovery, and they certainly do have incentives now to increase oil production.
Crapo also took issue with Yellen's advocacy of an international minimum corporate tax, which he said would disadvantage U.S. companies. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Nancy Lyons, thank you so much. Nancy Lyons in our Washington, D.C. newsroom and bureau. So in keeping with kind of the conversation we just had, a great story on the Bloomberg terminal buyer Claire Ballantyne and Paulina Cachero. And the headline on it, parents are buying homes for kids that are priced out of the U.S. market.
Yeah, parents increasingly helping their adult children purchase homes, whether that means co-signing a mortgage, giving money for a down payment, or buying the property outright. This is important here, Carol. It's according to real estate agents across the country. It's kind of hard to get hard data on this because that data doesn't really exist. But in their reporting, they spoke to real estate agents around the country to get some ideas of how this has increased in recent years.
It's kind of like our own little beige book, right? In
Exactly.
terms of real estate.
Yeah.
So in New York, Coldwell Banker Warburg's Becky Danchik saying she has never seen so many parents buying homes for or with their kids in her 15 years as a broker. Since January, she has worked with 4 parent-child combo clients, 3 of whom are paying all cash. We actually, I think I had a guest in our studio, which will remain nameless, who I believe talked about one of their kids buying some real estate.
And we were
I'm
both thinking,
assuming
wait a second,
there might have been
where
an
did they get
assist.
the money for this?
Maybe it's a wrong assumption, but I'm just saying.
That's a good point. Take this example. Karen Rowan decided to help her 24-year-old daughter, Cassidy Leonard, purchase a 3-bedroom townhouse in Denver for $330,000 last year. Leonard had been renting a 1-bedroom in the city's hot real estate market when her landlord hiked the rent to $1,600 a month from $1,400 a month.
Yeah, the 48-year-old businesswoman providing about $30,000 for the down payment and closing costs and co-signed her daughter's mortgage to help her qualify for the loan. The decision panned out just a little over a year since the Denver townhouse purchase. The property's value has increased by nearly $100,000. Full disclosure, one of my siblings has thought about, rather than waiting until they pass away, is to help out their kids and say, let me help you with, a down payment, and this way you're not paying rent, and thinking about helping with some real estate purchases.
Also an interesting tidbit in here about an international buyer whose kid was at a college in New York who bought a place here because student housing was so expensive.
Right, and I think that has happened a lot over the past. Anyway, great read. You are listening to Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Consumer discretionary stocks are lower today. This is after Target cut its profit outlook for the second time in 3 weeks, given a build in inventory. The stock right now is being heavily traded. It's down about 4%, and it's helping to send the S&P 500 retail group, discretionary retailers, off about 1%. On the positive side, we had Raytheon Technology shares up about 2.8%. The company's moving its headquarters to the Virginia suburbs near Washington, D.C. The company says it's going to help it become a little more agile in supporting the government and aerospace defense businesses. We also have a lot of positivity in the energy space today. 2 analysts raising their price target on ExxonMobil today. The company is also poised to win a stake in a gas project in Qatar. We have ExxonMobil shares higher by about 4%, and as a result, we've got the S&P 500 energy group up about 3% right now. Dow Industrial Average ahead 0.3%. S&P 500 rising 0.4%. Similar gain for the NASDAQ Composite. I'm Doug Krisner. That's your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Really appreciate it.
We're excited.
We got a
about
full house in the studio.
We do. We're kind of excited about our next story, so we've been like chatting away here. A new issue of Bloomberg Business Week going to be out on newsstands later on this week, and this next story, already on the Bloomberg, can be found at bloomberg.com/businessweek. It's about one of the big stories of the past week: the departure of one of the highest-profile individuals in Silicon Valley. We're talking about Sheryl Sandberg, now former CEO of Meta Platforms.
Former, yeah. That's, she was
Weird,
there
right?
for 14 years, yeah. The story written by Max Chafkin, features editor for Bloomberg Business Week. He's with us in the Bloomberg Interactive Brokers studio. Max, also the author of The Contrarian, Peter Thiel and Silicon Valley's Pursuit of Power. Also with us is Joel Weber, the editor of Bloomberg Business Week. He's with us in the Bloomberg Interactive Brokers studio as well. As I mentioned, a full house in here, Joel. So funny last week.
All right, doesn't Tim sound funny, everybody?
It's a sultry voice, yeah.
Thank you.
We just got to get that out of the way.
Yeah, it's still happening. It was funny last week when Sheryl Sandberg's sort of, I guess we could call it an outgoing message, said that before she met Mark Zuckerberg, she didn't really know what the internet was.
Little ironic. She worked for Google before that.
Yeah, people gave her a lot of flack about that on Twitter, at least.
More than anyone else, I think Sheryl Sandberg, as Max writes in this story, which we'll talk with him about, really found a way to monetize that internet that she didn't understand. And that came down to ads and what she was good at, first at Google, and then probably better than anybody else in the history of advertising was this thing that she conquered at Facebook. And it basically made digital advertising the force that it became, and that has dominated Facebook and has generated billions upon billions of dollars for a select few companies. So Max, what really stands out to you here? Because now we're a couple days off of that first wave of news of her departure, but really, like as you write here, like there's a bigger legacy.
Absolutely.
That you can absolutely draw a line to Sheryl with.
And I think that she probably deserves credit. Maybe it's shared credit, but as much as anybody else, with sort of constructing the internet as it exists today, which is this giant advertising machine where it collects, enormous amounts of data, primarily through a handful of big companies, Meta, which is Facebook, of course, Alphabet, Google, Amazon, Apple, and so on, and uses that to create these personalized ads, which then, pay for, a whole range of businesses. It's really, as we wrote in the story, kind of the scaffolding of the modern internet. And what's kind of interesting about Sheryl Sandberg is that the thing that made her famous, her greatest achievement in business, the thing that, under maybe different circumstances would be setting her up for a run in politics or maybe a CEO job at another company, which certainly may happen, but it's gotten a lot more complicated where all of a sudden we have people, including Facebook, really, asking whether this was such a good thing. Maybe we don't want to live in a world where all our data is getting gobbled up by a handful of big companies and served back to us in the form of advertising.
We're thinking about her legacy. There's been a lot of thought about this, but she took this company that really needed to pivot. We talked about this with Joel last week, right after the IPO, right, where it stumbled out of the gate and then figured out how for this company to ramp up and make a ton of money quickly.
Yeah, and that was what was so weird about this kind of weird attempt to rewrite history in this outgoing post, because the thing she did at Google was, obviously internet companies have been selling ads, but Sheryl Sandberg's big achievement was saying to every small business owner, every business in America, you need to be on the internet. You need to be advertising on the internet. This is the way you're going to find customers. And it's like exactly what she built for Mark Zuckerberg. And I think like when you take a few steps back from this, first of all, I think it's very easy to say, oh, Sheryl Sandberg's career is over. We should be doing a retrospective. I don't think that's likely. She's going to she probably already has other job offers. I also think there's a very good chance of a political run, even though, yes, it's very complicated. Yes, a lot of people don't like Facebook. It's very controversial.
She and Matthew McConaughey can do it together.
But, she's got a lot of name recognition. She has, people forget, but she started her career in the Clinton White House, working for Larry Summers. She's got a lot of political experience, an amazing donor network. And, of course, she's, one of the best-known, tech executives in the world. So for all those reasons, I don't think she's done, but I do think it's going to be complicated going from here.
But in speaking of complicated, it does also come at a time where Meta is now called Meta, not Facebook anymore. It's completely shifted in the sense of not away from ads, but it does see the area of growth being this thing that is the metaverse. So in a sense, is that era of self-service ads, is that era of growth over, as you have, Google controlling a big part of the market, YouTube owned by Google.
And Apple pushing back.
Exactly.
I mean, Apple really put a dent in Facebook's ability to generate income.
So no one knows, and I think that the part of the reason Sheryl Sandberg is leaving Facebook right now is because, as you said, Meta is moving away from the thing that she knows really well. The thing that she really knows well is selling advertising, and the plan, if you listen to Mark Zuckerberg, is to move away from that. Now, I think there are reasons to be skeptical of that. Apple, of course, is imposing all of these, privacy rules, and Facebook, Meta has said that that's going to impact the company's revenue. We haven't really seen it impact Google's revenue quite as much, and I also think just because they impose these new standards doesn't mean digital advertising is going away. It doesn't even mean that personalized, data-driven advertising is going away. What's going to happen, and it's already happening, is that the data will be increasingly collected on these platforms. So Apple won't let Facebook collect data on the iPhone, but Apple will certainly collect data about all of us on the iPhone. Facebook, meanwhile, can collect data in all the apps it controls, and so on.
Max, we read about how AdWords and AdSense was, Google's flagship products, and that Sheryl had an involvement in creating those. I'm curious, what do you think historically, what will be the bigger accomplishment? That effort at Google or what she accomplished at Facebook?
I mean, it's very hard because both of those efforts are extremely important and consequential. I think the Facebook thing, at least at the moment, feels like the bigger change because it took this. Google was using search data, and search data. You're telling Google what you want. Google is looking at what you're telling it and spitting back something at you. The machine that Facebook has built and that Sheryl Sandberg was instrumental in building is really about looking at all this stuff you're doing on the internet, looking at who you're friends with, and kind of trying to read your mind. And that's less direct than I think what Google was doing, and that's why it kind of feels creepier. And it's that kind of creepy mind reading ability that I think is very much her legacy and is just a feature of the internet, for better or worse.
Except for when it serves me ads of something I've already bought. That's always it's like, come on, I did it already. You won.
I kind of like that when they do that.
Yeah.
And I'm like, yeah, you're not that smart, are you?
And hence why you just keep buying stuff.
Well done. Anyway, check out the new issue of Bloomberg Business Week. It'll be out later this week. This story, though, already on the Bloomberg terminal and at Bloomberg.com/Businessweek. Our thanks to Business Week editor Joel Weber and, of course, to Max Chapkin, features editor at Business Week.
Countdown to the Close, Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close, just 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Masser and Tim Stenemick back, and together we go across all audiences, TV, radio, YouTube, to discuss, again, volumes so muted, but we are holding on to gains today, Carol.
Yeah, we definitely are, certainly in the broader market, but take a look at retail. It's having a tough time. Thank you, Target, cutting its profit outlook for the second time in 3 weeks. So the group overall, which had been up about 10% since late May, seeing some selling today, down about 1.5% overall.
Bitcoin also having a rough day, nearly wiping out the last 3 days of gains. It continues to trade within this relatively narrow range. Now, we don't have any fundamentals to talk about here because we're talking about crypto, but some interesting technicals. It's only risen above $31,000 twice in the past 3 weeks.
And you guys, you can feel free to comment on Tim's voice because it's really
right.
kind of sexy and deep today.
Hello, good afternoon.
Well, thank you for soldiering through, Tim. We like your dulcet tones back on the show. Meanwhile, I mean, you're lower, volume's lower by 24% on the S&P 500, but actually the S&P up 0.5% in terms of the actual index moving 24 points to the upside. We're seeing the Dow Jones Industrial Average also move about 0.5%. We are range bound across our benchmarks today, 166 points up. And we're seeing the likes of the NASDAQ hold on about 0.6%. Ross 2000, actually, the small cap is your outperformer of choice today, up 20 points. That's more than a percentage point higher, Taylor.
Energy is up 65% for the year, which is just unbelievable considering it's up an additional 3% today as well. That just continues to be the theme for the day, the theme for the huge year that we've seen so far this year. I think what is interesting is you also have technology up there as well. You're up about 1% or so, all the way down at the bottom, discretionary. And I know, Romain, we've talked a lot about Target and the likes and some of the discretionary names getting hit a little bit harder today.
Yeah, absolutely. I mean, of course, energy stocks, I mean, they are on fire. ExxonMobil now pretty much holding right at those levels from 2014, up about a 4% here on the day. A pretty outsized move for a company of that size. Meanwhile, to the downside, we talk about Target. It's not just Target moving lower, but just kind of dragging down anything retail related with it. That even includes a behemoth like Amazon. Those shares down about 2% on the day. We should point out Walmart, Dollar Tree, Costco, pretty much everything in the major retail space moving lower on the back of concern about what Target is seeing and whether that affects the rest of the companies. Robinhood shares down about 6%, seeing a lot of weakness, in fact, in a lot of the companies involved in the trading space, including Schwab and Virtu. This on the back of that news that the SEC is considering, is maybe prepared to put out some new rules with regards to some of the transparency requirements on those trades. And I just wanted to point your attention here real quickly to Raytheon. This is actually close to my heart here. This is going to be the first time in decades where all 5 of the major U.S. defense contractors are located in the Washington, D.C. area. Raytheon, which of course is up there in Waltham, Massachusetts, going to be moving its headquarters down to D.C. And of course, this comes, a week after Boeing announced that it was going to leave Chicago and move its headquarters to the D.C.
Oh, it was the Chicago pain, wasn't it? That was the
pain.
Is this to be closer to lobbyists?
Yeah,
Carol, that's such a cynical view.
I'm so sorry.
The money.
Come on.
Follow the money.
Been around the block a few times.
Gasoline is expensive, and so it's easier to walk over and lobby.
They're reducing their carbon footprint.
There we go.
All right.
Meanwhile, talking of carbon footprint, talking what oil prices are, gasoline prices, we've been talking about it all day, that inflationary pressure. Look, the commodity complex is crescendoing, as this chart for our radio audience is saying. Once again, an all-time high on the Bloomberg Commodity Index. I mean, you name it, and we're higher. We actually seen a bit of a pullback in some of the metals today because of that warning on growth coming from the World Bank, but we're seeing instead a WTI crude up 1.4%, and really this is helping drive some of those inflationary pressures ever upwards, Carol.
All right. Let's get to that World Bank forecast. Sorry, I'm a little obsessed with Matthew McConaughey at the White House today. Anyway, Caroline, you mentioned the World Bank cutting its global economic expansion forecast in 2022 further. They're worried about several years of above inflation forecasts and below average growth lying ahead, and the impact it's going to have on the developed economies, but in particular, certainly the emerging world. World Bank President David Malpass catching up with our team on TV earlier today. Here's what he had to say, his warning.
Many countries will have a hard time avoiding a recession. We're not in, it's not a global recession yet. It could, the downside risk is that it could be a global recession. One of the key variables is whether supply comes back online in order to add growth and slow down the inflation rate. But this is the sharpest slowdown in 80 years.
And of course, that's World Bank President David Malpass earlier on Bloomberg The Open. I do wonder, guys, we're looking at differences in terms of the global economy. Everyone seems to be dealing with higher prices, but you do wonder if we see just growth everywhere slow down, how much that means this economy and this turn back and turn down will just mean it goes on longer and longer and longer, and then it's something really significant.
Yeah, I want to home in on one part that he said here. When supply comes back online, that's what he's looking for. And the question there is, with these lockdowns in China, and they are starting to ease in the Shanghai area, to what extent does that dent, actual supply of products, of goods around the world? And it's not just that, of course, it's also about global energy supply and global energy demand.
Well, the disruptions are there, Tim. And I think when I was listening to Yellen's testimony, and, everyone sort of focused in on her admission of they sort of embraced transitory too long. But what I thought was a little bit more interesting was this idea here that really kind of what ails America really is what ails the world right now. And that even if we try to fix things on our end, there are going to be so many external pressures that maybe are outside the control of the White House and even outside the control of the Fed.
Right.
And just to take the flip side of that, Target would probably tell you there isn't a supply problem. There's actually too much inventory problem. So if we're all worried about these supply chain problems, there are pockets when there's a lot of inventory and then a lot of discounting that actually might be good for consumers in a couple quarters.
But when does it become a demand problem as well? We spoke with Dr. Cecilia Rouse, of course, earlier over the White House, and looking into, ahead of the interview with her, thinking about some of the polling of how people feel right now. More than a third of Americans feel dissatisfied with their finances, the highest level since the NORC, close to your heart remain, because this one's from Chicago too, began even asking that question in 1972.
Right. Well, of course, we know Chicago, of course, is sort of the birthplace of modern
of all intelligence.
And not to brag, but in all seriousness, you talk about this idea here of sentiment here. We're going to get that CPI data. We're also getting sentiment data this week here, and that continues to trend lower. So no matter what sort of those numbers say, there's a feeling out there right now, except for Carol, but the rest of us have this feeling right now that, things just are a little unsettled.
Do you know I actually put goods back when I was checking out the supermarket because it was so expensive. It was off the chart, and I thought, you know what, I can wait to purchase this. It was just...
What was it, white or red?
There's no waiting for that, my friend. There is no waiting.
All I'm going to say is check out one of the most read stories on the Bloomberg. Feeling pinched on a $250,000 salary? Just wait, because it really tells you about some concerns to come. All right, we will continue. Wasn't wine, by the way, Romaine. Okay. We will continue this conversation. We are going to count you down to the close in less than an hour's time. Radio, TV, and YouTube, Beyond the Bell, coming your way in just a moment.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I did. I actually was checking out, and I just seemed so off the chart. I think it was paper towels, and it was like $25, $30. And I just said, really? I think I probably still have some at home. And it just, to me, felt like it was crazy expensive.
For some reason,
was I wrong?
No, you're not wrong. Paper towels, if you don't, I don't want to get too personal here, but I have been in the situation where I've put paper towels back on the shelf too.
Right?
Because this is Brooklyn. You live in New Jersey. I live in Brooklyn where space is at a limit.
Yeah.
But I went to grab paper towels to, one roll. It was like $5.99 for one roll. And I was like, you know what? We're going to order this online.
Right. Exactly.
I'm sorry, but we're going to order this online.
Right, because I know it'll be less expensive. And this was after filling up my tank.
I saw the tweet over the weekend.
It wasn't even all the way because I must have pulled it out beforehand. $100, and it wasn't even all the way.
You got it to stop at 100, or it stopped at 100 automatically?
I think
because some pumps, that's their limit.
I think it stopped.
Yeah.
Because I was trying to throw some more in.
I remember this being an issue in 2008 when the last time oil prices were this high.
I was just because you had just talked about filling up your tank, and I thought, oh my gosh. So it's real, right?
Yeah.
Yeah.
And that's, I think, where the sentiment comes in, Carol. Because if people are seeing what they're paying at the pump, and that all spells politically. That all spells really bad news for Democrats in the fall.
Yeah, exactly, and we'll see that probably play out in the midterms, right? We all always talk about it's the economy's stupid, that old slogan, but it's the truth. When you go to vote, how do you feel? Do you feel like you're better off under this administration or not? And as Romaine was saying, what's going on is a global phenomenon, and these are things that are not going to be fixed by one government's policies. It's just not.
I'm just going to say, look at the unemployment rate.
Right.
You got a strong labor market.
I know.
The worker has power right now.
Yeah, exactly. All right, more to come. You're listening to Bloomberg Radio. Let's get to World and National News. Back to Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. An emotional plea from actor Matthew McConaughey, who is in Washington trying to convince lawmakers that reasonable, practical gun reform is needed in wake of the mass shooting in his hometown of Uvalde, Texas.
We start by giving McKenna, Layla, Miranda, Nevaeh, Jose, Javier, Tess, Rogelio, Eliana, Annabelle, Jackie, Azuya, JC, Jayla, Ava, Amory, and Lexi. We start by giving all of them our promise that their dreams are not going to be forgotten.
McConaughey spoke during the White House press briefing after meeting with President Biden. Also meeting today with the president was Democratic Senator Chris Murphy, who briefed him on Senate negotiations to write legislation addressing those mass shootings.
Good conversation. Obviously, we've still got work to do in the Senate. I'm grateful that the White House is giving us the space necessary.
Senator Murphy is part of a bipartisan group of senators that's working on a compromise that would improve background checks, institute red flag laws, and provide more mental health services. Michael Bloomberg, the founder and majority owner of Bloomberg LP, is a donor to groups that support gun control. Several thousand migrants have started walking through southern Mexico, covering ground before the heat of the day. The largest migrant caravan of the year provides a live illustration to regional leaders meeting in Los Angeles this week for the Summit of the Americas, expected to discuss managing immigration flows. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master along with Tim Stenovic live in our Bloomberg Interactive Broker studio. And this story by our Sejal Kishan. ESG, Tim, you and I have talked about this a lot, about a reckoning for ESG. We talked about it a lot when we were at the Milken Conference out on the West Coast now it's like about a month ago or so.
Yeah, it's exactly a month ago.
And so I do feel like with what's happening at Deutsche Bank, their DWS unit, so this story says, with ESG being increasingly maligned these days from both the inside and the outside, some of the industry's early devotees say it is time for a course correction.
Jerome Dodson is the retired founder of one of the world's largest ESG-focused investing firms, said a dedicated watchdog is needed to help police marketing claims. Marcela Pania, who's worked in the business for 15 years, said ESG issues need to be considered separately as opposed to lumped together. And then Matthew Kiernan, a pioneer when it comes to ESG corporate ratings, said that both the industry and regulators need to double their efforts to stamp out exaggerated claims and root out bad actors.
Yeah, the list of insiders discomfited by the growth of the industry, valued at about $40 trillion by analysts at Bloomberg Intelligence. They have put out numbers and also talked about the growth in ESG investments. It's just staggering. They have jumped exponentially in the past year alone. They bemoan, that is the list of insiders uncomfortable with the growth of the ESG industry, they bemoan newer entrants that have jumped on the bandwagon to market investments that have little real-world impacts. They say widely used ESG ratings are riddled with errors and need to be standardized, and they want asset management firms to face tougher scrutiny. I would say hallelujah, because how much have we done panels, interviews, and everyone just slaps ESG on it, and not every ESG investment is the same. Like, where's the transparency? Where's the understanding in terms of where your investment dollars are going?
I think you saw a lot of this come to a head with what happened with Tesla recently in S&P, with Tesla essentially being told it was not an ESG company. And then you have energy companies, you have oil companies in there that literally are extracting.
I've had panelists at Milken talking about that.
Natural resources from the ground.
That Tesla's not there, but your oil companies are.
Exactly.
Yeah, it does feel like a reckoning is coming. Anyway, a great read. Sejal has more on this story, so check it out at Bloomberg.com. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market trading very near the best level of the day. Long-term interest rates are down, and certainly that's been one positive. Let's get a closer look at the price action. Bill Maloney is standing by at the Bloomberg Macro Squawk Desk. Hi, Bill.
And good afternoon, Doug. U.S. stocks in the green in a choppy session today. The Dow's currently up 172 points. S&P's gained 27, while the Nasdaq is higher by 85. The U.S. 10-year yield at 2.97%. Gold is up 13. Oil is also climbing, but Bitcoin is down by 4%. Among the main 11 S&P sectors, only consumer discretionary was in the red, and leaders to the upside in the Dow, Salesforce, Chevron, and Apple, while Walmart and Home Depot led to the downside. In deal news, Reuters reported that Elon Musk's efforts to get new Twitter funding are on hold, and in other news, Target cut its profit outlook for the second time in 3 weeks. Wrapping things up, Casey's General reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Doug?
All right, Bill, thank you. And that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. Bloomberg Business Week is brought to you by Informatica. In the cloud, your data has the power to do the extraordinary. Manage data across any location in the cloud for accurate and actionable insights. More at Informatica.com.
Well, Tim, I recently conducted a panel for Bloomberg Live. Actually, it ran out today on thriving in the new normal, leading through geopolitical volatility and compressed transformation. I did so with Anya Manuel, co-founder and partner at Rice Hadley Gates Emanuel. They consult with global companies. Flex CFO Paul Lundstrom, they're a global manufacturer, and Pierre Breber, the CFO at Chevron. In this clip from the interview, the group shares thoughts on how to manage the current rough and volatile environment.
Agile and resilient are the watchwords. Condoleezza Rice, my other business partners, and I advise U.S. CEOs on geopolitics. And so it's been an exciting few months. And I think the good lesson that most of the CEOs we work with have taken away is they were a little bit blindsided. They didn't quite see Russia coming. I think there's an untold story here that U.S. businesses reacted so well. I mean, really had their values out front, did what they could for their own employees in Russia, in Ukraine, went well beyond what the sanctions required and really found their values as corporations. And that's a really good story. And now what we're doing with a lot of our clients as a follow-up is saying, okay, so we did that in Russia. Russia was a tiny amount, usually, of U.S. companies' revenue, but China is a huge chunk of their revenue, and the supply chains run through there, everything that Paul was talking about. So now we're doing a lot of conversations. How do you make that part of your business more resilient? How do you think about diversifying and having a pan-Asia strategy, exactly what Paul talked about, rather than just a China strategy? How careful do you have to be about R&D in China, where it's inexpensive and they have great engineers, but spies are likely already in your system? And a whole list of things running through indicators. What are the break glass things that could happen in U.S.-China relations that would really make you have to rethink as a CEO, whether you need to make sure your expats are safe, whether you need to move your operations out of there, or whether you can continue to do business?
Well, and, Paul, come on back in on this, because I do think if for anybody who's out there, this concept of nearshoring or onshoring, is something changing when it comes to globalization, which we know has benefited so many globally, and many would say it's hard to go back on this. But how do we need to? Is there going to be something different going forward about more nearshoring and onshoring?
Well, I think it has changed, and it hasn't just been the last couple of years. It's been for, I don't know, at least at Flex, it's been for 15 years. You look back 30 years ago, and it was, manufacturing it was all about labor arbitrage, and so you saw a lot of work, moving overseas to take advantage of lower labor rates. Interesting stats here. This is just for Flex, but 15 years ago, 56% of our sales came out of Asia. So it was for export, but it was produced in Asia, 56% of the business. Last year, 37. So over the last 15 years, you've seen about a 20-point drop in production in Asia. Now, does that mean that we're exiting, Asia? No, absolutely not. I mentioned before, we're going to produce in Asia for Asia. We're going to produce in Europe for Europe. We're going to produce in the Americas for the Americas. And there's going to be export out of all of those regions as well. But I think that's just that as the supply chains have grown more and more sophisticated, as end customers want their product closer to the end customer, we've just been repiping the network.
So Pierre, you know what I was thinking too? You've been at Chevron for a long time, and I feel this way when we talk about the financial markets. I do like talking with folks who've seen a lot of different market cycles. Not every market up and down is the same, and we know that. And I've heard a lot of folks talking about this is different this time around, and we talk about it certainly from a Fed balance sheet perspective, going from an economy that dropped like a rock to bouncing back like a ball. How do you think about this current cycle? As you said, there's boom and bust certainly in the energy market. How do you think about this one? Is there something different that is shaping strategy or some of the conversations that you're having with your CEO, Mike Wirth?
All cycles have similarities, fundamentally demand and supply getting out of sync because, again, they operate on different time cycles. And yeah, they all have differences. If you go 08, 09, global financial crisis, 14, 15, largely specific to the industry and supply responding, and then COVID. So what does feel different about this one clearly is ESG and the, we have been an out of favor investment for a long time. I know the energy sector has performed well for the last year, but if you go back 10 years, and for most of the last decade, we've been a flat stock with a growing dividend, but a flat stock in a market that's tripled. And if you go back 5 years, the market's doubled. And again, we were flat till very recently. So we still have a long way to go to win back investors. But what we're seeing is clearly the constraints on capital investment is a difference. ESG investing is a much bigger trend than it was, the last couple of crises that we've had. You have European companies under a lot of pressure to shrink their business. We have not. We intend to grow our traditional business and our new energy business. We think we can do both, and we know we can do both. But we have some major competitors that are shrinking, getting out of the business, essentially. You have Saudi Aramco, which is a public company. So yeah, there's always some differences, and it might cause this cycle to stay up longer. But fundamentally, it's a cyclical business. We're prepared for a correction. We show our investors what we call downside resilience, upside leverage. So we at $50 Brent, so less than half of where we're trading right now in oil prices, we can invest in the business, we can grow the business, we can grow the dividend, and have a strong balance sheet. And of course, at prices above that, we'll generate excess free cash flow and we can buy back a lot of shares. So when oil prices were negative, we knew it wasn't going to last forever. When oil prices over $100, we know that's not going to last forever either.
All right, that voice, Pierre Breber, the CFO of Chevron. Also on that panel, Paul Lundstrom, the CFO of Flex, a global manufacturer and supply chain solutions company. And then, of course, Anya Manuel, co-founder and partner at Rice, Hadley, Gates & Manuel. They specialize in scenario planning, and they consult global companies when it comes to global markets. Check out more at BloombergLive.com.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Master along with Tim Stanovec live in our Interactive Brokers studio. I mentioned retail earlier, certainly one of the underperformers in today's session, and that's largely because of what Target had to say today.
I should also do an honorable mention for Boxed. It's the company that was sort of like the online Costco, down 35% today, Carol.
Oh, wow.
After a lockup expiration. This after it fell 20% yesterday.
That's painful.
Another retailer getting hit.
All right, we're going to talk with our Jen Bartashis in just a moment. But first up, let's get back to your top business stories. A look at that trading day. Doug, just about 29 minutes to go.
Yeah, speaking of the retailers, consumer discretionary is the only one of the 11 industry groups right now in the S&P showing some weakness. You put your finger on the culprit. Target stock is down 2.5%, off the worst level here after cutting its profit outlook for the second time in 3 weeks. Apparently, there's been a build of inventory. But generally speaking, the market is positive, and you can attribute some of this move to the upside by a pullback or to a pullback in long-term interest rates. A 10-year Treasury that's down a little more than 5 basis points in yield now at 298. Dow Industrial Average very near session highs. We're up about 0.7%. The S&P is ahead by about 0.8%. Using the WEI function on the Bloomberg terminal, you can see that energy is clearly the driver here to the upside. The entire group is up about 3% right now. We have two analysts earlier in the day raising their price target on ExxonMobil. The company also poised to win a stake in a natural gas project in Qatar. We have shares in ExxonMobil right now higher by more than 4%. And brokerage stocks in the minus column. There are reports indicating the Securities and Exchange Commission is considering some changes. It would require trading firms essentially to compete for the execution of stock trades from retail investors. The S&P investment banking and brokerage sub-index is down about 0.3%. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, thank you so much. So Target tanks and shares of Kohl's kick up, a tale of two retailers. Covering it all is our own Bloomberg Intelligence senior retail staples and packaged food analyst, Jen Bartashis. Tim, she joins us via Zoom from our Princeton, New Jersey bureau.
Jen, good to have you with us. I want to start with Target because we are seeing shares lower by about 3% off of their lows from earlier today. This after the company cut its guidance for a second time in just a few weeks. Why did things change so quickly for Target?
Well, I think really this is an execution issue. And when you think about it, when we had the earnings a couple of weeks ago, I think that they thought they would have more time to sell through that inventory. And somewhere in this span of 3 weeks, they've really decided to just cut it and get it done. And it's likely because they're starting to look forward to the back to school season, the holiday season, and they want to make sure that they're going into those with really a clean slate and are well prepared.
You know, Jen, it's funny. Paul Sweeney earlier on radio said, well, wait, isn't this what retail is all about? That they're supposed to be experts in managing inventory. Having said that, we're in a really strange environment that I think a lot of retailers have tried to order extra to make sure they don't run out because of the supply chain problem. So how do we think about what Target is saying with that kind of backdrop?
Well, I think that there are still certain categories where retailers will continue to make sure that they are well stocked, whether that's on the grocery side, whether that's on some of the more essential side in terms of paper goods. But when you're talking about more discretionary items, those are really the areas that we're talking about now. We're seeing that consumer spending is pulling back, the savings rate is falling. That means that for categories like apparel or electronics, and even to a certain degree sporting goods, these are areas where consumers are now saying, you know what, I think I'm good. And so there's this excess inventory that's been built up that now they really need to try to get rid of. And don't forget, we had a really cold spring, and so there's a lot of apparel that didn't sell. And now they're trying to make up for that as well.
So it's not a case of them missing a trend. It's a case of just having too much stuff on hand and not the demand.
Exactly. It really is. And it's, Target is actually quite good at trends, right? That's part of why they have such a loyal following from their customers. But the other aspect to all this inventory conversation is, don't forget that when they talk about the cost of inventory, there's inflation baked into that to a certain degree as well. So they may not have an absolute larger number of physical items on hand, but the value of those items has changed because of inflation. And so there's also that part of the calculation that doesn't always get brought up into the conversation that you can't forget about as well.
That's a really smart point.
Well, I'm so glad you brought that up because I'm wondering about how we can read into broader economic consequences, or not even consequences, but the tea leaves about the broader economy just by looking at what Target is saying, because in a sense, this is deflationary, right?
Well, this is really a choice by the retailer to liquidate overstocks that they have on hand. The options you have are to either try to sell through it slowly or to try to just liquidate it quickly. And it sounds like Target has come to the conclusion that they want to try to just get it off their books quickly. Whether other retailers are going to be in a similar circumstance is really coming down to the type of retailer they are and what their individual strategy is dictating. We saw really mixed results through the earnings cycle that we just went through with regards to different types of retailers flourishing or struggling in the current economic environment. And I think that general overarching trend is something that we're just going to be continuing to see as we head into the latter half of this year.
And Jen, as you point out, though, I mean, Target, what they're saying is murkier because they did maintain their sales guidance for the year, right? So it's not
exactly.
It's nuanced, I think, as you write. There's a story on the Bloomberg, and they quote you. This is a nuanced report from what we got from Target.
It is, and when you think about it. People are still buying things, and they it's just that it's about what they're choosing to buy, and how much of inflation is playing into the actual basket costs of what they're buying. So the top line, there's a reason that they haven't changed that, and part of that is supported by inflation and just prices naturally rising, but part of it is just that there is a shift in product mix of where people are spending their money, and that Target has one of the strengths of their business is that they have multiple categories.
Yep.
And so they have the ability to shift as well. But at this juncture, they're a little bit behind that shift. And so now they're trying to make up that ground and reset as we head into the second half of the year.
Hey, Jennifer, we have 30 seconds left. Got to get your comment on Kohl's, up 10% after saying it's in exclusive talks about a potential $8 billion takeover from Franchise Group. That's the owner of Pet Supplies Plus and The Vitamin Shop. Your take?
Well, obviously, there's been a lot of interest in terms of an outside buyer for Kohl's. I think that clearly investors are indicating that they see a good opportunity for the company to be taken over. But we'll have to see what happens during this period.
Do we still need a Kohl's, Jen?
Sure. Again, they have a lot of loyal fans, right?
Yeah.
And so it's really about who are the core customers, and is that core customer still in the healthy spot to where they can support that kind of business?
Always love checking in with you. Jen Bartoshis, she is Senior Retail Staples and Packaged Food Analyst, breaking it down, the Target news, the Kohl news. We're following it all as she is. She is a part of our Bloomberg intelligence team.
Let's get to world and national news now. Nancy Lyons in our D.C. newsroom. Hey, Nance.
Thanks, Tim. Actor Matthew McConaughey grew up in Uvalde, Texas, where 19 students and 2 teachers were killed last month in a mass shooting. Today, he took an impassioned plea to lawmakers in Washington, saying it's time to enact a package of bills to stop gun violence. He wants to see them raise the minimum wage to own an AR-15 to 21 and impose a waiting period to purchase those guns.
Responsible gun owners are fed up with the Second Amendment being abused and hijacked by some deranged individuals.
McConaughey also wants states to impose red flag laws. Michael Bloomberg, the founder and majority owner of Bloomberg LP, is a donor to groups that support gun control. Residents in 7 states are voting today in one of the busiest primary days of the year. They're in California, Iowa, Mississippi, Montana, New Jersey, New Mexico, and South Dakota. Bloomberg government's Emily Wilkins says inflation is the issue.
There's really only so much that the Biden administration and Democrats can do to get these prices down, but it's very much impacting Americans, and it's giving Republicans a lot of confidence in a midterms year where they were already expected to come out ahead. This is just the wind at their backs at this point.
Bloomberg government's Emily Wilkins. A new Siena poll finds many New Yorkers are not happy with Mayor Eric Adams. Pollster Don Levy says Adams only received a positive job rating of 29%.
You add together all the events, the pandemic, inflation, crime,
and it's unsettled New Yorkers. And so the mayor faces a very, very difficult challenge.
Levy says 3/4 of residents fear they'll be the victim of a crime. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, along with Tim Stanovic, live in our Bloomberg Interactive Brokers studio, streaming on YouTube. I just want to say, before we went to air, Tim's like, check it out. Like, we're seeing buying here. We are.
Yeah, look at that. The S&P 500 is up close to a full percentage point, as is the NASDAQ.
You had something that was a decliner that's now a gainer.
Yeah, it's very frustrating. Peloton was lower for the entire day until now, so I have to find another stock in the red, Carol.
It ain't over yet. We still have, 19 minutes to go. So
Yeah, great. Just enough time for me to find something that's going to move higher.
In the meantime, let's get to a story by our own Jenny Serrain and Yurekui Yang. PayPal Holdings will let users transfer certain cryptocurrencies to other customers, exchanges, and external wallets, a new service that's part of the company's efforts to boost usage of its app.
Yeah, the company also said that the New York Department of Financial Services granted PayPal a, quote, bit license that governs businesses working with virtual currencies, according to a statement on the firm's website on Tuesday. PayPal said it was the first company to convert a conditional bit license into a full one. So, okay, think back to 2020, late 2020.
Okay.
That's when PayPal first started to allow customers to buy, hold, and sell Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. So it's been almost 2 years.
So now this new service lets customers transfer those coins, including from crypto exchanges such as Coinbase Global. So, I mean...
Does that mean, Carol, so does this mean that you and I can pay each other in crypto?
I guess. It means we can transfer them as payments?
Yeah, I guess.
Yeah. This story also goes to remind us that PayPal pivoting away from a strategy of simply trying to add millions of new users and instead is seeking to encourage existing customers to use its app more frequently. So I guess trying to add services, right, so that you can use it for multiple things. I mean, right, we're seeing this with all of these financial apps to some extent. The more, think about it, it's sticky. If I can do things more on one app, I'm more inclined to stay there and use it and then be entrenched in it.
Exactly. And don't forget PayPal owns Venmo. So Venmo is like the big peer-to-peer payments platform along with Zelle, which is something that's controlled by the big banks.
An exec over at PayPal said this is really about access and utility. We are greatly enhancing the utility of moving crypto around. So crypto, despite all the volatility, everybody's checking it out and how to use it. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Fewer than 13 minutes until the closing bell. The equity market trading very near session highs. One positive, long-term interest rates are down today. That's giving some support to the overall equity market. We've got the 10-year Treasury off by more than 5 basis points in yield to 2.98%. Right now, we've got the S&P 500 trading up about, let's call it 0.9%. Energy shares out in front of this advance. The entire group better by about 3%. Industrials and healthcare also showing some positivity. The only group within the S&P that's negative, consumer discretionary, responding to Target cutting its profit outlook for the second time in 3 weeks, given a buildup in inventories. Target shares right now down about 2%. Cathie Wood's ARK Investment Management is suffering a steeper drop in assets than nearly any other U.S. ETF issuer so far this year. Bloomberg data showing a drop of 48%. That's across 9 different ETFs from the beginning of the year through June 1st. Now, the high-profile ARK Innovation ETF is off more than 53% so far this year, although today it's higher by about 2.8%. Incidentally, Bloomberg's Ed Ludlow will be speaking with Cathie Wood, 1 p.m. live Wall Street time here on Bloomberg Radio. And Raytheon Technologies is trading up by nearly 3.5%. The company's going to move its headquarters to the Virginia suburbs near Washington, D.C. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
The West has united in opposition to Russia's invasion of Ukraine. The developing world, not so much. Instead, many governments in Africa, Asia, and Latin America have made a point of not taking sides. Such countries see the war in Ukraine as a proxy fight between Moscow and Washington, one where they have little at stake. The U.S. must persuade them that their interests would be better served by aligning with the West. It can start by offering prompt and generous support for countries struggling with war-related food and energy disruptions. It should also improve its messaging, for example, by framing the conflict not as a campaign to punish an autocratic Russia, but as an effort to aid Ukraine's fight for self-determination. A powerful nation started this war by scorning sovereign borders. That's a threat all countries, regardless of wealth, can recognize. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just got about 10 minutes left in today's trading session. As Tim mentioned early, we are seeing some buying into the close. So we are at our highs of the session, up about 1% on both the S&P and the NASDAQ, 0.8% higher on the Dow Jones Industrial Average.
Eager to hear what our next guest has to think about it. Eric Clark is portfolio manager at Rational Dynamic Brands Fund. Eric joining us on the phone from San Diego. Eric, how are you?
I'm good, Jim. How are you?
Doing well. I imagine it's a beautiful day in sunny San Diego. Help us make sense of what's going on today, because the narrative today was, okay, bad numbers from Target, revising its profit outlook again for the second time in 3 weeks. We saw stocks slide, and now we're seeing some real buying into the close with the S&P 500 higher by a full percentage point. How do you make sense of it?
I think every day the market has a mind of its own. Sometimes it's a little oversold and in need of a little bounce, and sometimes it's a little overbought, and then shorts come in, and so we're locked in this trading range over 3750 on the S&P, and 20 at the bottom ends of the VIX, and who knows, at 40 plus on the upside of the VIX, and we're just chopping around until we get some more real data on if inflation can be contained and how the Fed is going to revolve around that. So micro is trumping micro in the fundamentals for now.
All right. I want to get to what you've been doing in terms of buying or selling. Your fund, by the way, beating just about all of your peers over the past month, up nearly 3%, according to our data here at Bloomberg. Over the past 5 years, returning on average annually more than 12%, putting it in the 63rd percentile, according to our data. But the top holdings are household names. It's Blackstone, it's Apple, it's Tesla, it's Home Depot and Lowe's, Microsoft, Alphabet, KKR. That's as of the end of April. Have you been doing any buying and selling, Eric, amid the volatility of 2022?
We are a very active fund to begin with, so turnover tends to be higher because we like to trade around the core names that we love, and particularly in times when the VIX is over 20, trading opportunities are usually pretty much everywhere. And so if you can hold some cash, like right now we have about 11% cash, that's strictly to be used for short-term tactical trading. Could be in a name that we love that we already hold. Could be in a completely new name that we just see an opportunity. So
is that a high cash position for you, Eric? Based historically, it is. Okay.
Yeah, I mean, in the fourth quarter of 18, when we were really nervous about the Fed doing what they're doing, we were as high as 35%. But typically we're 10% or less cash. And right now, until the market breaks that 37.50, which it certainly could, anything's possible if earnings estimates start to roll over, or QT doesn't seem to be doing well because of the credit markets are seizing up. I mean, there's any number of things that could make us go up in cash. But for right now, we're just trying to trade around the core names that we love because the volatility is higher.
So what have you been buying? What have you been selling?
Well, we have trimmed some Tesla. Elon loves to just, he's so impulsive. I mean, the guy's clearly a genius, but he's so impulsive.
He's not
Some
impulsive.
of the things that he does. So this whole Twitter thing is a big distraction, and it may affect the stock price. So we've trimmed that one. I still love it. I'd love to buy it again. Down at 500. We've really been beefing up probably the biggest mega trend that I see, and it happens to be in our own industry, is this migration of money away from stocks and bonds because of a variety of reasons, but into alternatives, private equity, venture, hedge funds, those kinds of things. And Blackstone is kind of the Apple of the private equity business. KKR is the second largest. And this isn't your grandfather's private equity. So these guys have stable, predictable earnings. Between the two of them, about $1.5 trillion in assets. Blackstone yields over 4%. They're just, when you have a bunch of companies that have, $200 billion in dry powder to take advantage of whatever chaos happens because of inflation, that gives you a really good comfort zone. And I know there's lots of talks about the venture side of it with markdowns. That's absolutely happening. You're going to see it with every private company, but they're not real focused on that part of the market. They're in infrastructure and real estate and rental houses and much more stable businesses. So I just love that industry, and it's pretty underowned in most portfolios. So that's about 13 plus 6 or 7. So that's almost 20% of the fund just in KKR and Blackstone.
Wow.
Yeah, I was going to ask about that, and because of what private equity does in an environment like this, but that was a good answer. I wonder about Costco and how you're thinking about Costco. It's interesting today. The company that was looked at as the online version of Costco Box, it's one of my decliners today because it's falling another 35% after falling yesterday. Why are you optimistic about Costco?
Well, they just seem to manage inventory better than anybody. I mean, this management team and how they pay their employees and the loyalty they have and the loyalty with the memberships, the mousetrap is just better than anybody else's. And, the stock is never cheap. It's, trading north of probably it's 30 times earnings or something. But in this kind of market where there's, little mines everywhere on the field that you're playing, Costco's stability, their dividend growth, the growth outside of the U.S. is worthy of a premium. And so I'm much more comfortable, adding to Costco. In fact, the day that Target got beat up the last time when they reported their earnings and the stock was down like 35%, I didn't buy more Target. I bought a ton more Costco, and I have since traded out of that because it went straight down and then it went straight back up again. that's the kind of market environment we're in. So in that category, I'm certainly concentrated in Costco because I just think they're better at managing inventory than Walmart and Target in particular. Although if Target goes down a little bit further, I'll probably get more engaged with Target again because demand is not the problem. It's just excess inventory and managing that supply demand or that's, the supply chain, which has been really tough.
Yeah, interesting. I love having you on. We talk specific names, and I do love that you guys are active, so we really get a feel of kind of where you've been going over the last few months and gives us some insight for investors. Hey, Eric, thanks so much. Eric, of course, he is portfolio manager at Rational Dynamic Brands Fund. Eric Clark joining us on the phone from San Diego. Just a few minutes left in today's trading session, folks, and our major equity average is pretty much hovering near our highs of this session. Right now, coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast with Carol Massar and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, and YouTube here. A wild Tuesday here where it looked like we were headed for a down day here, Carol, but a lot of strength here headed into the close.
Yeah, absolutely. We've been seeing some buying here, right, in the last half hour or so in terms of trading. I'm going to be a little serious. I know I was having some fun with Matthew McConaughey earlier, but I'm looking at, he's talking about the seriousness and need for gun reform. We see it coming out of Washington, and yet you look at a name like Smith & Wesson, it's up another 2.5% in today's trade. So it's just interesting to see how investors play some of the news that's going on there, Tim.
Yeah, and Romaine, you mentioned the range that we saw today, a real wild day earlier in the session. The NASDAQ 100 falling as much as 1.5% and moving as high as more than 1.1%. S&P 500 falling as low as 1%, up as high as 1.05%.
Meanwhile, I'm going to be like a broken record, but volumes are off by 22% versus your average over the last 20 days. We're seeing off by 32% on the Dow Jones Industrial Average. So we move higher, but again, where's the commitment to the rally, I suppose? Where's the actual volume coming in?
Gosh, I feel like there sure is commitment within the energy sector. Romaine came over to my desk to bug me about something, and I had a big debate over about Valero at a record high. Exxon, Romaine, you were talking about sort of the record highs. The energy
you guys have
sector.
scintillating chat, don't you?
That's an interesting,
You guys are buds. For those of us in the newsroom, you guys are buds.
We are buds.
Secret buds.
You are.
65% rally on energy. It's incredible.
Fossil fuels are back. Sorry. Too soon? All right, let's we'll walk you through the closing bells as we hear them and see them here in New York. The Dow Jones Industrial Average going to finish the day higher by roughly 0.8%, roughly about 260 points as we wait for these numbers to settle. The S&P 500 going to finish the day higher by about 1%. We're just going to round up here, basically about 0.95%. Similar story for the NASDAQ Composite, up about 1% here on the day. And the Russell 2000, that's your outperformer here on the day, folks, up about 1.6% here on the day. And we should point out just real quickly, a lot of these gains really came within the last couple of hours of trading.
As Caroline mentioned, not a lot of volume, though, or conviction when it comes to the overall trade, especially on an up day, but nonetheless fairly broad-based because we're looking at the S&P 500, 419 names to the upside, 84 lower, and 1 unchanged, Taylor. So fairly broad-based here today.
Yeah, and Carol, you certainly see that on a sector level as well. We dive sort of 2 sectors underneath the surface within the S&P 500 for our radio audience as we do sort of the sector best performers and the worst performers. And like you said, it certainly feels like there's a little bit of that conviction, particularly as we dive underneath the surface. As we've been mentioning, energy certainly big outperformer. You're still up more than 3% or so on the day. Technology is also, though, in there. You're up about 1.5%. I'll bring you down to the bottom. I know, Carol, these could be some of the stocks that you talk about, sort of the food and the staple index and that retail sector. Those are the big losers today. You're off about 0.5 to 1% or so. Some of the big comments, of course, coming out of Target that we'll get to later.
Yeah, let's talk a little bit more about retail because Kohl's is certainly, we know Target was under a lot of pressure. That was certainly, as it revised again, its outlook, for the second time in about 3 weeks. On the upside, Kohl's up about 8.25% in today's session. This, as the company said, it's having some exclusive talks with a buyer group, a potential $8 billion takeover deal from Franchise Group, which owns Pet Supplies Plus and the Vitamin Shop. So some of that's going on, and certainly popular about maybe some
Liberty
interested
Tax.
buyers.
It's quite the little mix there of businesses.
You like it, right? It's kind of, and this would be, I think, the first time they get into like a retailer, right?
Yeah.
And things like that. All right, another retailer, Academy Sports and Outdoors. It's up about 8.8% in today's session. Their fiscal year comp sales, they did raise that, but they did bring in their fiscal year EPS estimate. But Stevens coming out saying the retailer's revision to its full year guidance smaller than feared, so some optimism there. And then Chinese names, I continue to obsess about what's going on and whether or not, finally investors are saying, wait, there's some bargains to be had. Top in the NASDAQ 100, Pinduoduo, ticker is PDD. E-commerce retailer, 700 million monthly active users, Seeking Alpha, calling it a business with a moat. This stock is up 127% since March 14th, still down 70% from its February 2021 high. But Tim, adding another 10% in today's session.
All right, you mentioned Kohl's as a gainer when it comes to retail decliners. We got to talk about Target, among the worst performers on a percentage basis in the S&P 500. Shares falling after the company cutting its guidance for a second time in just a few weeks. Target blaming weakness in discretionary categories. The company looking to ease an investment surge by marking down inventory surge, by marking down items and canceling orders. Also, looking at shares of Marathon Digital, the cryptocurrency mining company, finishing the day down by 2.7%, hitting a 52-week low, actually falling earlier in the session to its lowest level since December of 2020. This as cryptocurrency exposed stocks slid today with a Bitcoin's fall. And then look at this, Boxed, falling 35% today. Box shares just hitting a record low after falling 20% yesterday. The lockup period, 180 days after its December 8th closing date of its merger with the Seven Oaks Acquisition Corp SPAC expiring. Right. So another day of declines there.
Have people just stopped buying groceries? Is that?
I don't know what it is. I mean, it's really, this was a company that was sort of pitched as the online version of Costco, right?
Yeah.
But it's been a tough run for it in the 6 months since it's gone public.
Meanwhile, talking of some of the inflationary woes, perhaps those grocers such as Boxed are facing, let's have a look at what the commodities are doing, because once again, we've actually seen oil spiking back to its highest since March. Thin trading in the oil market overall, but the fact that we're back at $121 for our radio audience on the Brent contract, we're looking at $120 on WTI crude. Goldman Sachs, Morgan Stanley, both seeing that price could be taken out yet further to about $150. So clearly, inflationary push is front and center here when you're looking at oil. In fact, some of the metals got a little bit of a bid. We saw money come out of the likes of aluminium and copper as we debated growth going forward, with the World Bank tapping down on its outlook for global growth. But overall, it was a search for a haven like gold that happened in the commodities space. We're looking at the FX market, the Canadian dollar, the loonie gets some love, up 0.4%, strengthening as oil goes higher. The yen, no love for the yen, yet further macro shorts coming in on that. We're seeing it at the weakest in 20 years versus the US dollar, Aussie dollar, and indeed the Australian bond move. Extraordinary as we see once again more hawkish nature coming out of some of these global central banks. The Australian central bank upending economists. I think only about 2 of them had a call for such an extent of a rate rise coming from Australia. So the yields pushed higher by 17 basis points on the 2-year, and we saw the Aussie dollar up 0.6%, so strengthening versus the US dollar. What else happened in yields?
It was sort of a moment back into full faith and credit, Caroline. When we think about some of the key technical resistance levels on a 10-year, 3%, 3.25%, certainly been floated around. And Romain, you kind of saw that, where we tried to get above 3% yesterday and some of the buying came in. You had a 3-year bond auction that actually was okay, sort of average, but we're still looking at some of the highs that we haven't seen since about November of 2018. And you do wonder if that started to provide some relative attractiveness in yields that we haven't seen in quite some time.
Yeah, and you talk about the positioning too. I remember I was looking at a lot of that CFTC data that you get, obviously a bit backward looking here, but to see some of the positioning at the end of May really gives you a sense, at least where some of the bigger investors, institutional investors, as well as some of the hedge funds are looking right now. And it seems like they're still betting on the idea that, yields are going to continue to move higher. And of course, stock prices could potentially move lower.
Right, but that's not what we got today, right? We actually had stock and bond prices up and yields backing off a little bit. Does it feel like, Caroline and team, does it feel like all of a sudden the trend in terms of some of the news stories, whether it's corporate or just overall, feeling like things are starting to roll over? The economic data is softening maybe perhaps a little bit. I know it's small, but corporate conversations feel like they're a little bit more negative.
I felt that for about a couple of weeks. I couldn't find a single ray of light in the news flow in the last couple of weeks. But we are seeing overall, Target spilling into that global narrative that we got from the World Bank. These aren't great headlines, but with every negative headline perhaps comes an opportunity, perhaps comes the idea that certain valuations have been so beaten up, and we just had Binky from Deutsche Bank on saying, look, if you're a long-term investor, even if we do get a recession, look, stocks in the long term, they go higher.
Well, that's what I found so interesting about what happened with Target, because if we thought about the narrative in today's trade, it was really the Target news spreading across the markets. But then we saw buying late into the day, and it sort of, investors kind of took the Target news as at least relatively isolated.
All I have to say is I think we're pushing forward here to big CPI data.
That old thing?
Friday, that little thing that the markets might be worrying about, and more significant.
What's more important? The data itself or some of the commentary that we're getting out of these executives? I mean, because it's not just Target.
Except that the jobs numbers have been so strong.
For now.
And we've asked the Bank of America chief economist about the jolts. He says it's good. The numbers are good.
How many companies have we heard that have had hiring freezes or even paring back?
And 3 weeks ago.
we're not
the Target is changing, downgrading their profit outlook. Again, just 3 weeks later. I mean, some of these jobs data, I guess, are a little bit backward looking. That's why I guess always you cite the jobless claims, Taylor, because it's more high frequency data.
You wonder, though, if we get a shock in a jobs number, whether it's weekly jobless or jobs monthly, that all of a sudden it comes, whether it's next month or the month after, that all of a sudden it starts to catch up. But you're right, the jobs data continues to be strong.
Is Carol taking us out, or are we going to get the dulcet tones of Tim Stenovic here on the Quiet Storm?
I hope this is the last day you hear me like
I'm
this.
a little scared. I made him sit on the other side of the newsroom.
You guys are on radio, right, somewhere?
Yeah.
Oh, yeah.
All right, we got to run. All right, that's going to do it for our cross-platform coverage. Radio, TV, and YouTube. Beyond the Bell, we will see you same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser, Tim Stenovic, live in our interactive broker studio. I think it's a tricky time. I mean, as Caroline mentioned, she feels like the headlines have been negative. I feel like all of a sudden...
I think the only executive you hear saying positive things is Brian Moynihan at Bank of America. He still talks about consumers being in a great place.
It just feels like the tone has changed.
Yeah, you're absolutely right about that.
But you said, too, look at the job market. Like, when does that roll over?
Exactly.
And does it roll over quickly? Like, do all of a sudden just things fall off a cliff? Which we hope not. We hope we get to see the signs early. We hope the Fed gets to see the signs early. All right, let's get back to world and national news. For that, Nancy Lyons, once again, she's in our 99.1 newsroom in Washington. Hi, Nance.
Thanks, Carol. Actor Matthew McConaughey wants Washington to make changes to gun laws now. He's from Uvalde, Texas, where 19 children and 2 teachers were killed in that mass shooting last month. He spoke at the White House press briefing today and called out any legislators who are hedging on change.
Can both sides see beyond the political problem at hand and admit that we have a life preservation problem on our hands?
McConaughey says it's time for lawmakers to be leaders and not just live for re-election. He says responsible gun owners are fed up with the Second Amendment being abused and hijacked by deranged individuals. Well, Democratic Senator Chris Murphy says he briefed President Biden today on Senate negotiations on gun reforms. Murphy says the president feels any step is a step forward, and he's encouraged by the renewed talks. Michael Bloomberg, the founder and majority owner of Bloomberg LP, is a donor to groups that support gun control. Inflation has been in the spotlight today on Capitol Hill. Treasury Secretary Janet Yellen says there's one main cause for rising prices that's impacting nations all around the world.
Putin's war in Ukraine is having impacts on energy and food prices globally. We're not the only country that's experiencing inflation. You can see that in virtually every developed country around the world.
Yellen, speaking before the Senate Finance Committee, says Congress can take action to mitigate the costs of rising inflation by approving bills to lower drug costs and reduce U.S. reliance on fossil fuels. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nancy, thank you so much. So, Carol Masser, Tim Stenovic, we are at Bloomberg headquarters in New York City in our Interactive Broker studio, Bloomberg Interactive Broker studio. This story by our Bloomberg News team talking about a senior Chinese economist at a government-run research group calling on authorities to seize Taiwan Semiconductor Manufacturing Company, TSMC, if the United States hits China with sanctions on par with those leveled against Russia.
All right, quote, if the U.S. and the West impose destructive sanctions on China, like sanctions against Russia, we must recover Taiwan. This, according to Chen Wengling, the chief economist at the China Center for International Economic Exchanges. The research group is overseen by the National Development and Reform Commission, China's top economic planning agency.
Now, these comments are some of the most prominent so far, showing how Taiwan's chip industry is seen in Beijing as a key strategic asset in the intensifying rivalry between the world's two largest economies, the U.S. and China, of course. TSMC is the world's largest contract manufacturer of semiconductors, accounting for more than 50% of the global foundry market. This is why when they do something or say something, or demand or supply changes, it impacts the global markets, which involves, though, businesses purely making chips for other companies. That's what they do.
Have you heard of Apple?
Huge customer of TSMC, which relies on Taiwanese chips for iPhones. They are increasingly looking to do their own chips, though, right?
Yeah.
Apple.
We should note it. Exactly right. We should note a TSMC representative declined to comment on Chen's remarks. Media reports have said that TSMC will build 6 chip fabs here in the U.S., but the company has announced just 1 so far. It has bought more land for possible construction.
You know, and here's the big broad backdrop. Chinese President Xi has sought to achieve tech self-sufficiency and tapped economic czar Liu He to shepherd a key initiative aimed at helping domestic chip makers overcome U.S. sanctions. I mean, there is a tech war coming on. So many guests talk about it. We're going to talk about it with Andy Purdy of Huawei Technologies. He'll be on in just a moment. But, you know, this is what's going on more globally.
All right, well, speaking of what's going on globally, we got a red sticky, as you've told me they're called, Carol, here at Bloomberg. Citadel Securities and Virtu form a crypto plan with Fidelity. More on that on the terminal.
Yeah, you're listening to Bloomberg Business Week, and this is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market was higher today. We finished very near the best levels of the session. One thing in the market's favor on the equity side was a drop in long-term interest rates, a 10-year Treasury that gave back more than 6 basis points in yield. We were last quoted in New York at 2.97%. There is a cautious tone, somewhat cautious ahead of that crucial reading on retail inflation. We'll get it on Friday. It's the Consumer Price Index report. The numbers for May illuminate the cost of living pressures that we've been feeling. Today, Treasury Secretary Yellen was saying she expects inflation to remain high. 12, check that, of the 11 industry groups within the S&P 500, only one was negative. Consumer discretionary, as a group, weaker by about 0.4%. And you can blame Target. The company cut its profit outlook for the second time in 3 weeks. Shares were down today by about 2%. On the positive side, Raytheon Technologies picking up nearly 3.5%. The company's going to move its headquarters to the Virginia suburbs near Washington, D.C. The company says the move will help it become a little more agile in supporting its government and commercial aerospace customers. So far this year, Raytheon shares are up nearly 17%. Measure that against the S&P 500, which is down nearly 13%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Well, Huawei has battled for survival since the U.S. barred it from buying an array of imported components, from Qualcomm's most advanced chips to Alphabet's Android system 2 years ago. Companies looking for growth in emerging businesses, such as wireless communications products that are used in coal mines and smart cockpit solutions for electric vehicles. They're really looking for growth in a lot of areas.
We're very pleased to have back with us Andy Purdy, Chief Security Officer at Huawei Technologies USA. Andy joining us once again via Zoom from College Park, Maryland. Andy, how are you?
Good. Actually, I'm in San Francisco for the RSA conference.
Good to have you with us in San Francisco. Remind me, why are you there?
The RSA Security Conference is this week.
Perfect. There it is. What are the big topics that are at the RSA Security Conference now that it's back in person?
There's a lot about zero trust, technological innovation, cybersecurity risk, cloud. I mean, it's just everything is covered.
Well, I've been at that event. Yeah, it's really fascinating. I do feel like, Andy, certainly when we talk with CEOs of companies, and we found this when we were out at Milken on the West Coast, is that when it comes to if companies have to rein in spending at all, depending on the economic environment, they're not necessarily going to do it when it comes to tech, and certainly not when it's tech related to security. The spend is on. Tell me a little bit about your outlook. We know that last time around, in terms of earnings, it was a little tricky for you guys. What are you seeing? I think your profit was down about 67%. I know a lot of it has to do with U.S. sanctions against you guys. What's business look like right now, and what's the outlook?
Well, certain of the components that we haven't been able to get have dramatically hurt our 5G mobile phone business. But in the other areas, we have been holding our own in terms of our 5G networks. Our enterprise business has done tremendously well with digitalization. That's really transforming business. We've been selected by 267 of the global Fortune 500 companies to do their transformation. And we've had great success in terms of what we call the seamless AI life experience with mobile devices, wireless handhelds, those kinds of things, where we're making a big difference. And frankly, because given the challenge of moving forward, we've made a gigantic investment in R&D, up from 10% of revenue to 22%. We spent $22 billion last year in R&D. We're making great progress with it.
How much would you characterize these sanctions placed by the United States are affecting the business? How much is it holding back from more companies in the Fortune 500 adopting your technology?
Well, it's hard to say. Certainly, our global revenues for 2021, as you know, were down like 28%, which is a dramatic cut down to just under $100 billion. We have so many countries in the world that are interested in doing business, so many companies that want to do business with us. Our 5G is all over the world, and we're having great user experience. And frankly, what I'm encouraged by is that we are so open to collaborating with whoever, including the U.S. government, private companies, on some of this R&D that's going to be necessary to move from 5G to 5.5G. The connectivity that's going to be necessary will have to grow 100-fold every year. So we have to push some of the scientific theories, and we'd love to collaborate with the experts around the world to do that.
Well, and what's interesting, you talk about 5G, but I have conversation after conversation about 5G hasn't lived up to its expectations. We've done some reporting here at Bloomberg. What signs do you have that maybe is changing?
Well, in certain parts of the world where you have true 5G, because as you know, it's not just about speed, it's also about latency, the lag time, it's also about the number of connections. So moving toward an intelligent world, the 5G-enabled technologies are happening in great order in several countries of the world. So we're hoping that we can share the experience, not that we would necessarily do the business in the United States, but make sure that American sectors understand that these technologies are available now, and it's going to really help transform the companies, it's going to help their competitiveness, and it's going to help the citizens of those countries to get involved in it.
What hope do you have that President Biden, and let's get to kind of the elephant in the living room, that he will review those tariffs? He's talked about reviewing the tariffs imposed on imports from China, that something will change. And I'm curious about the conversations that you are having with folks in Washington, that anything significantly will change on this front.
Well, frankly, we are such a small player in this, and the business, even at its peak that we did in the United States, was not a material thing. So when you look at the factors that are taking place with the Russian invasion of Ukraine, COVID, other factors, you see the global community is concerned about changes in globalization. Because I think it was the IMF has said that globalization in the last 30 years raised over 1 billion people out of poverty, and we just hit. The Washington Post story said that we hit a record of 28.5 billion of goods traded last year. So we're a small player. Globalization has brought great benefits. So the global community has to be careful. Let's not throw the baby out with the bathwater. We have to reshape globalization. And so we're just a small player. We want to share information and collaborate, particularly on things like cybersecurity and innovation and some of these hard scientific problems. But we're just open, and we just want to try to do business where we're welcome, and we're welcome in an awful lot of places.
But do you feel like, okay, you're welcome in a lot of places. Do you anticipate that you'll be welcome back, small player or not, in the U.S. market anytime soon?
No, I certainly don't think we'll be welcome back in the U.S. anytime soon. I think in the long term, and I'm encouraged that the cybersecurity efforts of the United States government and the private sector in partnership have grown dramatically. It's recognized that, as I think we talked about before, there's no such thing as trusted suppliers. The bad guys can hack into everybody. So one of the things we're seeing here at the RSA conference is the efforts to raise security, to raise assurance, to implement the zero trust kind of principles that President Biden mentioned in his cybersecurity executive order about 1.5 years ago now. Those are the kinds of things that are necessary to make sure these technologies, as we come to get the benefits of them, will be dependent on them, and we've got to make sure they're going to be resilient, they're going to be up and running when we need them. And that's going to continue to require the public-private partnership and greater global cooperation for standards and independent testing of key components of everybody's products. And we're supporting that around the world.
To what extent are you concerned that the way that the United States has essentially blacklisted Huawei spreads to other countries at this point?
Well, frankly, I'm not concerned about it. I've been to 26 countries for Huawei, although I haven't traveled since March of 2020. We're still doing business in an awful lot of places. I mean, the fact I mentioned earlier that 267 of the global Fortune 500 companies have turned to us for their transformation. The Asia Pacific, all these countries are very interested in green energy, and we're really becoming a leader in green energy, partnering with folks to help develop greater capabilities to create the green energy, to transmit it, and to store it. And we're going to get an awful lot of business in the Asia Pacific realm, and I think increasingly in Europe. So it's a big world out there, and we've got plenty of business to do.
But Huawei can be just fine in a world without the United States. I mean, to be fair, there is a ton of equipment here in the United States that is running on Huawei parts and other Chinese companies because they were already here before the ban went into effect, the U.S. ban against Chinese-made components. But can Huawei have a future? You talk about, the global reach that you guys have in globalization. Is the U.S. market crucial to this company going forward?
Actually, as I said, we have not had significant revenues in the United States compared to our global revenues.
Yeah.
So yes, we can continue to do fine without any revenue from the U.S. But when you talk about globalization, the issue of the sanctions limiting the ability of the American semiconductor industries to sell to Huawei, now that has tremendous benefit for the American worker, because when we were at $12 billion a year in those purchases, that supports about 40,000 American jobs. So we hope at some point there will be a recognition, and there are discussions on some of the tariff issues. You saw the editorials in the Wall Street Journal and Washington Post recently, trying to get folks to say, let's look dispassionately at tariffs. Let's not put tariffs on Chinese goods if we can't get goods from somewhere else. We have to look at what's in the best interest of the United States. And I think that's a great standard. And I hope over time that will be something that the U.S. government will consider. But frankly, we're seeing a change in the global supply chain of semiconductors. The head of Intel was asked on TV last week when the U.S. will be independent in semiconductors. He said never. And what he said was, and we see it coming out of Europe, that there will be a transformation in the semiconductor market globally, 80% Asia, 20% U.S. and Europe, and it will be 20% Europe, 30% U.S., and 50% Asia. So we're going to see a transfer, a globalization, and we have reconstructed our product portfolio and our path forward. So if we're not able to get those chips from the United States, we're still going to be fine. And we're in survival mode, but we're going to survive.
In survival mode, but going to survive, Andy. I want to talk a little bit, you mentioned the supply chain, and I'm wondering what you can tell us about the global supply chain right now and what you're seeing in terms of components, and if you're seeing the constraints that we've all experienced over the last couple of years, and particularly over the last 14 months at this point. Are you starting to see those ease?
Well, not in a substantial way, but what we've been working on is to diversify our supply chain. We've also adjusted the products that we make to make sure that we have components that we know we can get, and we're pursuing those products, shortening the life cycle of other products. So and the greater research that we're doing in computing, in the power supplies, in individual digitalization of sectors, that we're going to find new business in those areas. And we're going to help inform those that are going to make chips around the world that some of the things that we've learned, we're going to be sharing with them. And so there will be more supplies from around the world. Generally, we've diversified our supply chain for those things we can get. And I think that's what we're going to see around the world. There's got to be greater diversification so that a company or a government can know they'll be able to get it from here, that they'll get it from there, and probably need some capability in the United States so that if really bad stuff happens in the short term and something's essential, then we'll have it. But look at something like have everything domestic and think that you're going to have what you need when bad things happen.
Right.
We have to have kind of overarching approach and still somewhat of a refocused, reshaped global supply chain.
Yeah, it's certainly something that I talked about earlier in that panel, the Bloomberg Live panel, when it comes to nearshoring, onshoring. I mean, people are making sure they've got good backup systems. Andy Purdy, thank you so much. Chief Security Officer at Huawei Technologies USA on the phone from San Francisco.
Let's get an update now from Doug Krisner, who's watching these markets and the trades in after hours. Hey there, Doug.
Hey, Tim. Positivity in the equity market today. The major indices finishing at session highs. The S&P today with a gain of about 1%. Of the 11 industry groups within the S&P, only consumer discretionary moved lower, and that was a result of Target cutting its profit outlook for the second time in 3 weeks, given some surplus of inventory. We have Target shares today down by about 2%. S&P 500 higher today by about 1%. Energy out in front. We had shares in ExxonMobil rallying by more than 4%. Two analysts have raised their price targets on ExxonMobil. The company's also poised to win a stake in a natural gas project in Qatar. Dow Industrial Average up about 0.8%. NASDAQ Composite today higher by nearly 1%. Long-term interest rates down today. That certainly helped support the equity market. 10-year Treasury last quoted in New York at a yield of 2.97%. So we were down a little more than 6 basis points in yield. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Carol Massar, Tim Stenovec, live in our Interactive Broker studio. Well, I feel like the world and the economy is potentially taking advantage of you. Well, you're not alone, and it's not all in your head. So writes our next guest, who can relate to us having been described as a, quote, fellow overwhelmed consumer, and has looked into the ways that middlemen have taken control of the economy at the expense of the rest of us.
Catherine Judge is a professor at Columbia Law, also the author of Direct, The Rise of the Middleman Economy and the Power of Going to the Source. Catherine joining us this afternoon via Zoom from New York City. Professor, how are you?
Doing well. Thank you for having me.
Well, thanks so much for joining us. I want to start with just the title of the book. How would you describe the middleman economy?
The The middleman economy is really the incredibly large middlemen who have taken over so many different aspects of the economy in ways that have also really fed and been fed by long supply chains. So it's not against middlemen, it's not against intermediaries. We need a lot of them. It's understanding how we have these particularly large intermediaries, how they're fed by these long supply chains, and then the ripple effects, the low prices, the efficiency, the convenience, but also the fragility and the opacity that come from that.
All right, I feel like this plays into, we were just talking with a senior executive over at Huawei Technologies USA just before you, who knows something about complex globalization and supply chains. So break it down for me, if you would, Catherine. And when you mean a middleman, tell me how it applies to, the average Joe on Wall Street, on Main Street, or just one of us. What are you talking about?
Yeah, so I mean, a lot of them are the companies that you see every day. It's Amazon, it's Walmart. In some ways, it's your bank, that you're going to get money if you need to borrow. They're connecting you with savers on the other side. But it's also a lot of people you don't see. So it's the wholesalers, right? So you see kind of the food. You're not seeing Cargill that's playing this huge role aggregating grain from around the world, and it really serves as the backbone. So it really is any time that there's these informational challenges and logistical challenges in the flow of goods and the flow of funds, we've become to really rely on intermediaries to help overcome all those frictions. And so the idea is that, look, this is really, really valuable, but it also has some consequences we haven't really thought about.
So is Amazon a middleman, or is it where are they in this chain?
I also view them as middlemen. So I use the term really to talk about, those companies that help us connect, but in the process of connecting, also separate. So it's about what we see and what we don't see as a result of relying on these intermediaries that, again, are helping to facilitate flows, but kind of changing the structure of the economy in the process.
Okay, so you mentioned Cargill. Talk to us about some of the other middlemen companies. Just for our investing audience, they're familiar with companies in the S&P 500 and a lot of the companies they can invest in. So give us some names here about who are middlemen.
Yeah, I mean, so I would actually break it down even on a more concrete level. I mean, you can think about your real estate agent as a middleman, right? I mean, so, and you think about the traditional real estate, again, they played an incredibly valuable role early on. They created this great infrastructure and multiple listing service. It allows us to connect before the internet to see the homes that were available. But now we still have 2 full service real estate agents generally involved in a real estate transaction. They're overcoming the information and the other challenges of coming to terms, but they're also really taking a meaningful cut out of that exchange.
6% in New York City.
I was going to say,
in case anyone is wondering.
And even when it's a little bit lower than that, it's still a lot of money. And again, for the wealthy, most of their money is in stocks, as you were just saying. It's in the S&P 500. For the middle class, housing is actually their number one source of wealth. Those really high fees take away from their bottom line.
I have to say, when I was, prepping for this segment, I was thinking, okay, so how do we get around this? Is this why we people like digital currencies or blockchain? Is this a way of cutting out all of those middle structures? And I think about that from the investing world. When I make an investment, there are a lot of people who benefit by my investment. And wouldn't I love to just go right to it and kind of cut all that stuff in the middle?
Yeah, and that's a huge part of it, is understanding how is technology changing the way that people can connect. And again, part of it is about balance. I think part of understanding what intermediaries do helps us understand where we really need them. And if you think about finance, there's so much fraud at times, there's so many informational challenges, there's a lot of benefits that they can bring, but we want to understand the trade-offs. And a lot of the idea in the book is right now we turn to intermediaries because they make our lives easier in the short run. If you're a company, it's easier to outsource sometimes than to actually build internally what you need, but there's long-term costs that come with it. So it's how do we rebalance to get what we want?
But at the same time, there's been the displacement of the middleman so much. I mean, I think about Nike, for example, going direct to consumer right now. And you have, in my life growing up on the Central Coast of California, there was a company called Tennis Warehouse. And it was actually where I had my first job. And they changed the game for the tennis industry. And they're facing pressure right now because the tennis racket companies are selling direct to consumer. So that retailer, that middle person, isn't necessarily there anymore. And perhaps, I don't know who's saving money in this situation or who's losing out, but it's certainly changed the game for retail.
Yeah, and that's part of what the book about is we're already seeing significant shifts underway. So there's been a huge direct-to-consumer. A lot of traditional brands have realized, look, we want to create a direct-to-consumer option. A lot of smaller companies are coming in. They're using Shopify to set up a website. We see Etsy allowing kind of individuals to actually sell homemade goods. And so a lot of it is like, how do we figure out the right balance? What are the changes underway? And it is about that balance. I mean, I will say for Nike, their story is both ways, right? They're going to direct-to-consumer, but they also have been a huge Amazon holdout for a very, very long period of time. Then Amazon acquired Zappos. And so, I mean, like, I think for a lot of companies, they're trying to straddle the line.
And it hasn't been great for Foot Locker either.
I mean, some of the traditional, I mean, there's a separate move underway where we're just changing how we shop, right? And that allows us to go direct, but it also allows us to become very reliant on Amazon.
Right, exactly. Well, going back to Amazon, like, how do you put Amazon, you know, I feel like they have provided this incredible transparency in terms of pricing, right? And we all, before I buy things, I often then go online, I check Amazon, I do multiple things, and I can do it in a minute or two, which I couldn't do before. And I do feel like that was a pro when it comes to, or positive when it comes to Amazon. And yet at the same time, I know they pull us into their network, and I'm probably am paying more for things as a result, because I'm like, it's Amazon, I'll get it easy, I'll get it tomorrow.
And that's exactly it. I mean, Amazon, I think, creates a real bind. There's no way not to respect the incredible innovation that has gone into the company, the resources they've created. I mean, you can go and get thousands of reviews. That's an information resource that didn't previously exist. And they're creating this fulfillment. Yeah, you get it tomorrow, you know you're going to get tomorrow. But part of what we're finding now is a lot of people are saying in surveys, I want to shop less at Amazon. I feel guilty when I shop at Amazon. Millennials, like a lot of them would actually rather give up sex or alcohol for a year than give up Amazon. And so part of it is like, how can we make it so there's just not as much of a disparity? So people actually have that choice when they want to make a different choice. And what is the infrastructure we need so people can opt out if and when they want to?
Well, and I want to get into the data component of it, because I do feel like we're at this crux where all of a sudden people are saying, well, wait a minute, you guys have all been making tons of money off of me because you know my data and you get me to buy things I really don't need. And we were just talking about this with Sheryl Sandberg, right, in terms of the model she created over at Facebook, now Meta. Hang on, Catherine. We're going to come back to you. We're talking with Columbia Law Professor Catherine Judge. Her book out, Direct, The Rise of the Middleman Economy and the Power of Going to the Source. We'll get back to her in just a moment.
Well, let's go to the source now in Washington, D.C. Nancy Lyons is standing by with an update on world and national news. Hey, Nance.
Thanks, Tim. Actor Matthew McConaughey is in Washington today to push for new gun control measures in light of the mass shooting in his hometown of Uvalde, Texas.
This moment is different. We are in a window of opportunity right now that we have not been in before. A window where it seems like real change can happen.
McConaughey spoke at the White House press briefing. On Capitol Hill, lawmakers have been hearing from witnesses who've been impacted by extremist thinking. Garnell Whitfield is the son of one of the victims of the deadly supermarket shooting in Buffalo.
I ask every one of you to imagine the faces of your mothers as you look at mine, and ask yourself, is there nothing that we can do?
Garnell Whitfield called on lawmakers to address what he calls the cancer of white supremacy. Michael Bloomberg, the founder and majority owner of Bloomberg LP, is a donor to groups that support gun control. Treasury Secretary Janet Yellen is assuring the Senate Finance Committee bringing inflation down is a top priority.
Ranking Republican Mike Crapo said administration policies discourage additional domestic oil production. Yellen disagreed.
Oil production in the United States fell during the pandemic. I think that oil producers didn't anticipate the strength of the recovery, and they certainly do have incentives now to increase oil production.
Crapo also took issue with Yellen's advocacy of an international minimum corporate tax, which he said would disadvantage U.S. companies. In Washington, Irv Chapman, Bloomberg Radio.
Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in D.C. We're going to get back to Catherine Judge. Her book, Direct, The Rise of the Middleman Economy and the Power of Going to the Source. We've got lots more questions for her, and we'll get back to her in just a moment. In the meantime, among our most read is by our colleague Jason Kelly, who's talking about Main Street Advisors. It has helped assemble everything from Beats by Dre to Lobos Tequila. Now, the California firm has raised $1.1 billion to make even more celebrity-heavy deals. This is what they do.
All right, so Jason goes into the history history of the firm. Born 25 years ago out of founder Paul Walker's work advising Arnold Schwarzenegger, Main Street has grown to counsel everyone from LeBron James to Bono to Billie Eilish on how to leverage their success in sports and the arts to build a business empire.
Yeah.
Go
sorry.
ahead.
No, go, please.
I was just going to say, with the new fund raised from some of those same stars as well as institutional investors, it's aiming for a larger role in those transactions. What I was going to say, Carol, is, increasingly we're seeing, it's so funny. Yesterday when I was homesick, I dropped my son off at school and a Casamigos tequila truck drove by. And of course, there it is, a picture of George Clooney driving on his motorcycle. And I recall that he sold that company for tens of millions of dollars.
Yeah.
Arguably more.
I thought he like over $1 billion.
Yeah, I mean,
wasn't it?
I don't know how much
Something
he ended up
crazy.
getting it. It was massive. And I thought to myself, this is what celebrities are doing. They're using their name, image, and likeness to make more money from building brands than by actually the art that they did originally.
It's remarkable. And you see it over and over again, a lot in the alcohol industry, because the margins and the markup on this stuff is phenomenal. And I've talked with Nick Jonas, I've talked with others, Cameron Diaz. I mean, they're all getting into this business. What?
Our friend from Outlander.
Sam Heughan.
Yeah.
He's got his own scotch. He's also, I think, introduced a tequila. Like, he's increasing what he has.
We got to get him back.
And like you say, they do this for a year, not a year, but usually multiple years, and then they turn around and sell it. Casamigos sold back in 2017 to Diageo for $1 billion. Isn't that amazing? This is...
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market was higher today. We finished at session highs. So here are a couple of questions. Was this merely a bear market rally? Are we climbing a wall of worry? Well, today, long-term interest rates were down, and that gave support to the equity space. We had the Dow picking up about 0.8%, and both the S&P and the NASDAQ comp were higher by nearly 1% today. We did have a trouble spot among consumer discretionary shares. Target cut its profit outlook for the second time in 3 weeks, given a build in inventories. Those shares were down today by about 2.3%, and it seemed to drag the S&P 500 consumer discretionary group lower by about 0.4%. A little bit of caution, too, ahead of that crucial retail inflation data due Friday. That's when we get the consumer price index reading for May. Maybe we'll have a little bit of illumination into some of the cost of living pressures that we are experiencing. Today, Treasury Secretary Yellen was saying she expects inflation to remain high. Cathie Wood's ARK Investment Management is suffering a steeper drop in assets than nearly any other U.S. ETF issuer this year. Bloomberg data show a drop of 48%. That's across 9 ETFs from ARK. Bloomberg data measuring the beginning of the year through June 1st. Now, the ARK Innovation ETF is down about 53% so far this year. Today, though, it was up about 3%. Incidentally, tomorrow, Bloomberg's Ed Ludlow will be speaking with Cathie Wood. It happens 1 p.m. Wall Street time, live here on Bloomberg Radio. I'm Doug Krisner, and that's your Bloomberg Business Flash.
I'm looking forward to that conversation, Cathie Wood and our Ed Ludlow. We are right now, though, having a great conversation with Catherine Judge, Columbia Law professor. She's got a new book out, Direct: The Rise of the Middleman, Economy and the Power of Going to the Source. She, by the way, her expertise includes financial markets, regulation, regulatory architecture, and she's the editor of the Journal of Financial Regulation and more. Still with us via Zoom in New York City. Hey, so Catherine, part of this book, or you also, you get into the middleman and the impact of them, but you talk about this cost and how this all rules our economy and our lives. What are the costs?
Well, we were just talking about inflation. Mm-hmm. One of the things that we have seen is that as the economy came roaring back after the pandemic, that really led to significant supply chain strains. And some of that was just because there was a lot of demand. But the effects of that were significantly accentuated by virtue of the fact that we realized a lot of companies didn't understand all of their exposures up the chain, and they hadn't planned accordingly. So you have car makers and others forgoing incredible amounts of revenue, and then prices being pushed up really significantly because they didn't fully understand their vulnerabilities. Similarly, we saw with Chair Powell and other members of the Fed, they've obviously been paying very close attention to the situation, but they kept us expecting early on that those pressures were going to be transitory and really self-correct in a faster period of time than that has happened. And we saw similar, dynamics on play in 07 and 08, where again, securitization had created a more effective way to allocate capital, it seemed, and to allocate credit. But these really long chains made it so throughout 2007, as the crisis was brewing and things were getting worse and worse, the Fed really couldn't get ahead of the ball because they didn't understand how the risks were allocated. So one of the big challenges, if we care about resilience, both for the overall economy, individual companies, there's a lack of information that makes risk management hard.
So what does it mean for regulators here? Do regulators need to get involved to prevent the middlemen?
It's not about preventing the middlemen. It's about helping to make sure, again, the balance is restored. So we have a kind of a new wave going on in antitrust, which I think has been very powerful. It's helping to understand how we have laws in the books that we're actually using. Congress is considering additional laws to make sure for kind of the largest intermediaries, particularly in the tech space, that they're not abusing that power. But a lot of it is also bottom up. Going back to the conversation about Amazon, a lot of people say that they want to be able to go somewhere else, and yet they're having a hard time doing it. So rather than kind of like starving the post office and making it slow down delivery times so that way it can be a profitable business, maybe we actually subsidize the post office and make access less expensive so for smaller players so people can opt out. So it's kind of a top-down, bottom-up. We're not going to try to achieve a level playing field. We're not going to try to eliminate any of the innovation that's happened, but how do we make it so the disparities are manageable?
Catherine, I feel like in an increasingly digital world, And Tim and I were talking about this, was it PayPal or, platforms?
Yeah, it's PayPal.
Right, and I think about like my household, it is largely an Apple household, and we just continue to add on to Apple because the infrastructure's there. It can all talk to each other, right?
Well, that's why Apple beefed up its pay yesterday.
Right.
So it would get you guys instead of you going to Venmo.
Right, and so then it gets to a point, so I get efficiencies out of that, right? But I also I'm hooked. And Apple's got to know that at some level. So that, same thing with Amazon Prime. I'm so hooked that when they raise the price, I'm like, all right, I'll deal with it because I'm getting X, Y, and Z. So what's the balance increasingly in a digital world where a platform that can do a lot, we get a lot out of it, but then we're also at the mercy of that platform?
And that's where competition policy has to play a really important role. And when we do see with things like Prime, and we have all these like food delivery apps that again are separating you from a restaurant that you used to go to directly.
Right.
And they make our lives more convenient, but they have all these subscription services. So we just keep using them and less money goes to the restaurant. And so part of it is like, what is the right balance? And particularly in these sectors where we do see kind of outsized market power, we have longstanding tools. They've been underutilized for a couple of decades now. We have a new set of policymakers that are really trying to bring them back to life. And a lot of the book is trying to figure out how do we do that when we're talking about intermediaries. Like when we have platforms that are connecting, but also standing between and then exercising outsized power, we need to make sure there's a special set of tools to really make this effective.
How do you think about this when it comes to ESG assets, right? Which is going through a reckoning at this point. So much money just flooding in, but yet, do we really know where it's going? Is it really going to ESG? How can we like kind of apply what you're talking about when we've got all these, whoops, I just threw my pen. All these middlemen, you're getting me excited. All these middlemen in the middle, right? That the money just goes places, but it's not necessarily that pure ESG play.
ESG is a great example of why we need to be tackling these challenges. So generally speaking, the economy right now assumed all investors cared about was maximizing risk-adjusted returns, for consumers, lowest price for quality of good. But now people are coming to the table. They're saying, look, I'm willing to pay a premium because I actually care about the environmental impact. I care about how workers are treated. I care about sustainability. But we have these incredibly complex chains, and there's just no way to take that system, slap on a label, and actually get the accountability that we want. So part of the point of the book is to go in, how did this happen? It occurred over decades. Incrementally, it grew and it grew and it grew. Now we want something different. We want something that's potentially more resilient from a broader standpoint, and individually, many of us want there to be more accountability. Well, we need to create a new type of system. And so it's how do we actually create shorter chains that allow meaningful transparency, so we're not trying to rely on some certification schemes that really is just like another party coming in and making money off of everything we don't know.
I'm lucky that Tim isn't feeling so good because I'm getting a million questions in and we both like want to just keep talking.
Enjoy it while you can.
He will be healthy in a couple of days. How do you apply this to social media? How do you think about that? Like, there's middlemen there too, right?
There are, and I have to admit, social media right now is outside of the contours of book because there's incredible overlap. It's similar in the sense that people that used to connect directly are now allowing their communications to be intermediated, controlled, shaped. And as you pointed out earlier, there's all that aggregation of data, which also creates power. So there's a lot of parallels, but there's also some distinct dynamics. So what I'm really interested in here is more kind of the Amazons of the world and the companies behind them than the social media, which there's a lot of energy, fortunately, already to start to try to tackle that problem.
I feel like it's so relevant to so many of the conversations we're having. Thank you. Our producer, Paul Brennan, said you were going to be great, which is why we wanted to give you a couple of blocks. You were, and I hope you'll come back soon. Delighted to talk with Catherine Judge, Columbia Law professor. Check out her new book, Direct: The Rise of the Middleman Economy and the Power of Going to the Source. Our own Brad Stone, author of Amazon Unbound and the Everything Store, said, if shopping at Walmart or Amazon has started to feel dangerously soulless, you must read this book. Just saying.
It's a good one.
I'm sorry you didn't feel well.
That's okay. I feel better now. I'll feel better tomorrow.
I hope you do. Some tea, some lemon. Take care of yourself. From the whole Bloomberg Business Week team, have a good and safe evening. This is Bloomberg.